My name is Jerry Salaya. I'm the Chief Strategist at Tricio. Hope you guys can all hear me. And thank you for joining our webinar. James is our Head of Investment Solutions, and he's in charge of letting people in. So he'll be doing all the background work during the webinar, while John Calverley, our Chief Economist, is actually responsible for presenting this webinar, which has a topic of a tale of two economic recoveries, COVID versus a global financial crisis. And I hope you enjoy it. It's being recorded, and we'll be sending copies to everybody once we edit out names and stuff, so you can have a copy for yourself. We'll let you know where they are. And we will be taking questions at the end, if that's okay. Please type them in. And we've already gotten some questions by emails from some clients, and we'll be asking those along with questions that you have as well. But like I said, we'll try to take them at the end, if that's okay. So having said all that, John, it's up to you now.
Okay, thanks, Jerry. I assume everybody can hear me okay. What I'm going to do today is to really make a big comparison between the economic recovery after the global financial crisis and the economic recovery we're seeing now. And I want to look at the economics of it, but also what happened in the markets, comparing last time with this time, and what we might expect going forward. So this chart shows the US economy over the last 60 years. The blue line is real GDP, trending up, but of course going down during the recessions. That's the red period. And you can see how usually the upswings last from 7 to 10 years. The last upswing was particularly long. Now we're going to see what happens in the current upswing, which has just begun. I'm going to argue actually that we may see a shorter upswing this time for various reasons. So we'll come back to that. So if we look at the causes and legacies of the global financial crisis and compare it with COVID, and let's just look at there's a lot of words on this slide, I know. So let's just look at the top left block, where it's the causes of the global financial crisis. And these are all familiar to you, I'm sure, but we had the US housing bust, which began in 2006, led to financial problems, and then the financial panic when Lehman was let go, a big mistake by the government and the Fed, but they did it. That led to the panic, that led to banks cutting back lending. Then we had a big slump in confidence and a slump in spending, and that took us into the recession, big time. If you compare that with COVID, really, obviously, it's a different trigger. You've got the lockdowns and the uncertainty, but then the same slump in confidence and the same slump in spending. Now let's look at the legacies, bottom left. So the legacies of the global financial crisis, well, weak housing, both construction and sales. And housing has a big impact on the economy, both directly and indirectly, because, of course, people buy furniture and fittings and so on. So that was a considerable drag on the economy, really starting in 2007, but continuing for many years after the crisis. Negative wealth effects, because stock prices fell, but so did housing, and housing is more important for most Americans, and I'll show a slide on that. Unemployment stayed high for a long time. I'll show a slide on that. We also had banks very cautious after what happened, and also because they were required to build capital. So they were quite reluctant to lend, especially for the first few years. That held things back. We had companies unwilling to borrow. They wanted to take less risk with debt. They had the experience of this very sudden drop in demand in 2008. And they also had the problem that lines from banks were suddenly withdrawn. So they generally wanted to take a much more cautious approach to balance sheets. And that meant having less short-term debt, more longer-term debt, less debt overall, and more cash on the balance sheet. And that had an impact on investment, as I'll show. And then we also had a clear perception that there was a fiscal crisis and that something needed to be done about it. And so we saw the austerity in the UK, saw the fiscal cliff in the US, and we saw attempts to hold back the fiscal deficits in Europe, which made the euro crisis worse. Now, if you compare with the COVID crisis, it's very different on quite a few of these fronts. First of all, housing is very strong. House prices are rising. Housing starts and permits in the US and elsewhere, indeed, are rising strongly. There's a lot of activity in the housing market too, and that, as I said, feeds through into purchases and so on. We've also got rather positive wealth effects. Those house prices, but also stock prices, bounce back much faster. We've got consumers with massive accumulated savings, around $2.5 trillion in the US, and similar amounts in Europe and the UK relative to the economy. We've got banks in pretty good shape. They raised, they didn't pay out dividends last year. They've had less of bad loans. They've basically a much stronger capital position anyway because of the capital accumulation over the last cycle. So there's no real issue there. The picture for companies, of course, is mixed depending on how COVID's affected them. Some companies are in deep trouble, some not affected very much, and some, of course, doing well out of COVID. So it's mixed, but the vast majority are not worse off and maybe better off. And then finally, I think, at least for now, we've got quite a relaxed attitude to the fiscal deficit and debt. Different, I think, to last time round. I mean, perhaps governments are putting off talking about this, and that may be part of it. But I think generally the politics has shifted a bit, and people do seem to be more relaxed about having big deficits, and there's no great urgency to try to reduce debt ratios. So let's look at a few charts of this, and this is just the pattern of the downturn. The dark lines here, the dark blue line and the dark green line, are the 2008 experience with the US and the UK. So you can see there's about a 5% decline in GDP and a kind of a saucer-shape recession, very, very gradual beginnings of recovery over these 7 quarters. Contrast with the COVID recession, very steep downturn in the second quarter of last year, and then a quick recovery. And you can see at the end there, we don't have Q2 2021 yet, obviously, the official data, but we know the numbers are going to be strong from the monthly data. And so we'll be back up well above where the path was in 2008. And here's the Europe picture. Again, sharp decline in the crisis, back more or less on the same track as in 2008 at the moment. But I've extended this to 28 quarters just to remind you that, of course, the Eurozone had a double dip. So it didn't actually get back to the 2008 level until 28 quarters later, 7 years. So very, very severe downturn for the Eurozone. Here's a reminder of the wealth effects. So this is the US household net worth. So that's total assets less liabilities as a percent of GDP. You can see in 2008 it went down sharply and took many years to come back up, got back there around about 2015. This time we're already well ahead of 2019. So much more likely to see positive wealth effects this time. I mentioned the savings ratio. Normally the savings ratio does go up in recessions. It did in the 2008-9 recession. It actually went up a bit further in the early upswing stage, which is a little bit unusual, and that contributed to the slow pace of upswing. Obviously, savings have been massive in 2020-21, and that's that accumulated savings that I mentioned. Here's the picture for unemployment. Blue line is the US. You can see unemployment last time round jumped up to 10% and then came down slowly. And it took about 8 years to get back to where it started. Now, this time round, the Fed expects unemployment to be back where we started by the end of next year. So that's less than 3 years. At Tricio, we think it might even be a bit earlier than that, a few months earlier. And the picture in Europe and the UK, I think, maybe a little bit slower, but still coming back quickly. And again, contrast that with last time. In the UK, it took 8 years as well to get unemployment back. And in the Eurozone, took even longer last time round to get unemployment back where it started. So it looks like a much quicker recovery this time all round. And here are our forecasts going forward. You can see the second quarter strong in the US and the UK, not quite as strong in Europe because the lockdowns continued for longer. And then continued recovery at a slower pace. But I want to draw your attention to the far right-hand side of this slide. So if you look at the blue line, you can see it's up to 107.5 by the fourth quarter of 2022. Now, this is just a forecast, of course, but that is 7.5% up over 3 years. That's just under 2.5% a year. That's pretty strong. That means you're back on trend, or maybe better than trend. And it's similar for the UK and the Eurozone here. UK up to 105, so that's about 1 2/3% per year. Given Brexit, that's pretty much what we would have forecast back at the end of 2019. And Europe up about 1% a year. That's, again, not far off what we'd have expected anyway. So this is different to what happened last time. Last time, the trajectory pre the financial crisis was not regained. We never got back onto that previous trend. And arguably, that led to some of the political tensions we saw in the last cycle. The election of President Trump, Brexit, the emergence of far-right parties in Europe, I think all connected to the fact that we were ratcheted down to a lower trend for GDP. And at least on our forecasts, it's going to be different this time. That's just forecasts, of course. If this happens also, it's very important for the fiscal accounts because it means the deficit at least could solve itself. We'll still have a higher debt ratio because that jumped up, but the actual deficits will go away relatively quickly once all the various schemes are wound down and if we get back onto this trajectory. It's also going to depend on productivity. Our forecasts are based really on demand. We expect strong demand, but actually how GDP works out over the medium run depends more on productivity. And that was another characteristic of the last upswing. That was that productivity growth was very slow. Blue line here again is the US. You can see it had been rising 2.5%. This is GDP per worker prior to the last recession, already slowing down a bit before the recession, but nevertheless then slowed down much more after the global financial crisis. UK even worse, very poor performance in the 2010s. Eurozone as well, quite a poor performance, although it hadn't been as good before that either. So one question then is, did productivity in the 2010s slow because of the global financial crisis, or was it other reasons? And this is impossible to answer with certainty, but I think there's quite a lot of evidence that investment was lower, and I'll show you a slide on that in a moment. And we know why that happened. That was due to the uncertainty after the crisis and the weak demand in the early stages, exacerbated by the fiscal austerity I mentioned. We had banks and companies restoring balance sheets, so less willing to invest. We also had lots of people unemployed, so easier availability of cheap labor. In the UK, we had quite a lot of immigration as well from the EU. So investment was held back, and usually it's investment that drives productivity. But there could have been other factors as well. There's quite a lot of evidence, I think, that GDP is actually underestimated because we're not fully measuring the new technology gains. That's controversial. I happen to think that it's probably slowed down GDP by 0.5% or more over the last few years compared to what it would be if it was being measured properly. But you can debate that. That still only accounts for part of that productivity slowdown, however. The other argument is that we didn't get much technical progress in the 2010s. We got smartphones and Twitter and Facebook, but we didn't really have major gains that really could drive productivity in the service sector or the industrial sector. The way that, for example, in the 1990s, we got the personal computer and the internet married up, and that made a big difference. So I think there's obviously hopes for the 2020s in terms of productivity. I'm a tech optimist on that, but again, that's a forecast. So here's the picture for investment. Again, the blue line is the US. You see the big drop in investment in 2009, and then a gradual recovery. This is simply investment in real terms, so it doesn't take account of GDP. So even when we get investment back to the same level in 2014 as it was in 2007, that's actually still a smaller share of GDP. It took a few more years to get back to the same share. And you see it's even worse in the UK and even worse than that in the Eurozone, many years for investment to really pick up. And if you contrast with the latest post-COVID situation, the US is already seeing in the first quarter investment significantly higher than pre-recession. Now, some of that may be delayed investment, and we may see a bit of a fallback. But actually, that's not what the investment intentions surveys suggest. So I think investment's going to stay pretty strong. And we're also seeing in other countries, again, investment intentions seem quite strong. I think we'll see the UK and the Eurozone perk up quite nicely over the next few months. So it looks like investment's going to follow a different pattern this time. So will productivity be stronger after COVID? It's a question mark. My answer actually is probably yes, we'll do much better this time, partly for the investment reason that I've already talked about. Also because we're going to have less availability of cheap labor. Unemployment is coming down quickly. We've got moves to raise minimum wages, big push in the US, although that tends to depend more state to state. Nevertheless, it is happening, and the UK as well, moving in that direction. In the UK, we looks like we're going to have less immigration overall. And also, of course, workforces generally are not growing as quickly because of population trends now than they were 10, 12 years ago. So I think cheap labor is going to be less available, and that's going to encourage, I think, investment in automation, which should help productivity. I think also the boost to digital activities that we've seen from COVID is going to help. Working from home, I think will add to productivity. Again, this is debated. There's different studies. Most of them, however, suggest that productivity is raised, and probably the kind of hybrid working that we're going to likely to go to will solve the problems that some companies have of when people don't go into the office at all. We should save office space, which is a productivity gain. We should be able to reduce business travel. If you think back to 2 years ago, some companies were using video conferencing, but not many, I would say. For most people, it was a choice between the telephone or go out and meet somebody. And I think now we've got a third option, the video call, and I think that'll be used somewhat more. So that should save money and time on business travel. Online administration, bookings, signatures, etc. Again, people were doing this before COVID, but now I think a lot more people are doing it. And I think that's going to make quite a big difference. It means that companies which previously had to have clerks and front office people meeting customers, now a lot of it can be done by the customers themselves. That's, I think, going to save. And finally, online education and health. Still early days, I think, to see how that works out, and it's controversial. It's going to require changes in working patterns, but I think over time that's going to make a difference too. So my guess is that COVID is a boost to productivity, and that the post-COVID upswing, we're going to see a better outcome for productivity. However, I think on the downside, we may have more inflation risks this time. Again, a lot of talk about this. We're obviously seeing some high inflation numbers, at least temporarily, in the US and the UK, and rising in the Eurozone as well. And obviously quite a lot of that is transitory. It's the effect of the fall in energy prices last year and other distortions. However, if economies bounce back more quickly and get back to full employment more quickly, that's potentially more inflationary. We have seen a big surge in US money growth. I'll show you a slide on that. We do have more dovish central banks, particularly the Fed, I would say. The average inflation targeting approach that it's now using clearly suggests that they're going to permit inflation to go over 2% for a while, even encourage it. And also they're not going to attempt any kind of preemptive moves on monetary policy. So that's a change. Another argument is that China won't be exporting deflation going forward. Wages are rising in China. Arguably the low inflation of the last 20 years or so had a lot to do with this sudden influx into the global workforce of workers in China and some other places, but particularly China. And that is largely over now. So we won't see the deflationary effect from that. The key, though, is going to be wages, and I'll speak a bit more about that in a moment. Here's the picture for money growth. This is M2 for the US, the blue line. You can see the big spike. M3 is a similar number as well. It's not so much true of the other countries, but particularly in the US, we've seen a massive spike in money. And of course, this is controversial. There are the avid monetarists who say this is bound to feed straight through into inflation. I'm not so convinced of that, but I think it's definitely something to watch, and it adds to the risks. So I mentioned wage growth, and that is crucial. So what this slide shows is unemployment in blue, coming down in the upswings and then going up in recessions, and wages coming down during the recessions and afterwards, and then later in the upswing, typically rising again. So that's the green line. So they're kind of moving in opposite directions, the Phillips curve, for those of you who know your economics. Now, if you go back to these last 4 upswings, this chart only goes to 2019, you can see that each time wages got up to about 4% or so in the US and then sort of peaked out, didn't rise anymore. And maybe that'll happen again this time. Maybe wages won't go above 4%. The Fed likes to argue that they've got inflation expectations anchored so that employers won't pay more than 4% because they know they won't be able to pass it on in prices. Alternative argument is that we just never quite saw unemployment get low enough. We never quite had the economy running hot enough before the next recession came along. So this time, if unemployment gets back well below 4% by the end of next year, which is the Fed's forecast, and keeps on falling, the danger is that wage growth picks up. But that is certainly what's going to need to happen for inflation to become a significant problem. So to summarize on the economics front, and then I'll talk about the markets. This time we've got more fiscal stimulus in the US and Europe, less in China. I haven't said much about China, but this is just one very big difference between the 2 upswings. Last time around, China had a massive fiscal stimulus, about 12% of GDP, not very different to what the US has done this time. This time, China has done far less, around 4% of GDP, and it's the US that's done the big stimulus. So there's kind of a switch around there. Economies, I think, are bouncing back more sharply. I think we see that already, and I think we will continue to see that depending on the course of COVID, of course. That's good news for growth. I think it's good news for investment, which we're already seeing quite perky, and I think that will be good news for productivity as well, which is, of course, good news for markets. I think we have greater inflation risks this time. I talked about that. Now, possibly the upswing won't last as long. And the reason for that is that if you get back to full employment very quickly, then you have more inflation risks, you have more risks of exuberance. There's just a greater danger in that stage of the upswing. When you're at full employment, people tend to be happier, take more risks. So there's a risk that this upturn is shorter. So what are the implications for markets? And I'll go through these in some detail looking at some slides. But first of all, I think we're likely to see official rate hikes earlier than the last cycle, and I'll show you a slide on that. I think we're likely to see rising bond yields this upswing, and probably we've seen the lows for bonds, and the kind of 40-year bull market is over. Again, I'll show you a slide. Stock markets usually rise during upswings, so it should be a positive backstop. Obviously, we get strong profits growth, but typically some of that rise is caused by a rising trend for valuations. And this time around, valuations are already higher than in 2009, especially in the US. And I'll just talk a little bit about currencies and where we stand this time compared to last time. So this was the path for official rates. Last time, basically, the Fed stayed on hold, and then finally, about 7 years in, started to raise rates gradually. The ECB attempted it in 2011 and quickly had to backtrack. And the UK basically flat for most of the period. So we didn't see much movement in official rates, really reflecting the slow pace of economic recovery and the absence of inflation. Well, this time round, if we see a faster recovery and we have concerns about inflation, and again, I'm not so much thinking about the current concerns because I think the central banks will certainly look through that. I'm more concerned about inflation in 2, 3, 4 years' time when we get back to full employment. But I think interest rates will rise sooner this time. Here's the picture for 10-year bond yields. You can see how after the last recession, 2009, yields rose, and that's what normally happens at the end of a recession, just like this time. But then from about 2010 onwards, we had a long downtrend in yields. Looked as though it might be being interrupted in 2018, but even before the COVID recession, yields were coming back down again. So basically, with inflation quiescent, with the economic recovery not that strong, bond yields continued on downwards. This time round, I suspect that because of strong growth, because of that inflation risk, that we will see bond yields tending to move up. And we've argued before, I think, in webinars that we should expect the US 10-year yield to move into the 2 to 3% range over the next year or so, and other yields to move up as well. Here's the picture for stock markets. Again, massive decline in 2009, an immediate recovery, and you can see we were up about 40–50% in the first year. So not that different to the current situation in that respect. However, that last time round, that still left markets well below where they were at the prior peak. Whereas this time, we're back near the peaks and above it in the US. So the quick rebound in the first stages of recovery is quite normal, but we've rebounded to higher levels this time than last time. And of course, that's partly a reflection of valuations. So valuations fell in the 2009 downturn and then picked up. But at that stage, if you look in the first year or two of recovery, you had the US and Eurozone at around 15 times on the cyclically adjusted price earnings ratio, US at about 20 times, and UK is not so different, but Europe is higher, and the US especially is a great deal higher than last time. And finally, on exchange rates, the dollar always, nearly always strengthens in recessions, as it did in 2009 and again last year. And then once the recession is over, other currencies pick up a bit. What we saw in the last upswing was that both the pound and the euro faded, really, I think, reflecting the stronger growth in the US and interest rate differentials. Obviously, the euro crisis and Brexit played a role here as well. We do start on relatively low valuations, particularly for the pound, which is why we're sort of thinking that the pound will gain ground over time as the Brexit issues are dealt with. That's a whole separate issue. We can come back to it in questions if you want. But we would look for the pound to pick up somewhat over time. So which assets did well in the last upswing? This is just history. Obviously, US stocks did best, but others did okay as well. Some returns figures here. This is taking from January 2010, so after the initial bounce up until the end of last year. This is annual returns. So you can see the US 13%, pretty spectacular for stocks. The UK, Germany, and emerging markets around 5, 6, 7, 8%. Those levels are kind of what you'd expect over long term for markets. Those are in the range of the expectations that most people sort of pencil in for what they would expect over the long term. Perhaps a bit more in emerging markets, but the US, of course, that was a stellar performance. Bonds were also a good investment. It didn't necessarily look like that, I think, back in 2010, when yields were 3 to 4%, and we were more used to them being 5 or 6%. But nevertheless, if you bought bond yields at that price then, you'd have been pretty happy. And of course, yields came down during the upswing, so there were paper gains on the way down. The dollar rose, as I mentioned, so that, of course, also supported US assets. And of course, UK and Europe weighed down by new events late in the upturn, the euro crisis and Brexit. So, bottom line, what's Tricio asset allocation today? Well, I said that I thought bond yields would rise, so we are underweight conventional bonds. We just think that a stronger recovery this time, the inflation risks make it not so attractive to hold conventional bonds. And of course, you've got a pretty low yield. We're neutral inflation-linked bonds because of that inflation risk. And then in stock markets, we are overweight US small stocks, Eurozone stocks, and UK stocks, large and small. And we're neutral US large and Japanese stocks. Again, this is we do expect the economic upswing to be sustained, and it's quite unusual for stocks not to trend up if you have an economic upswing going on, because profits do well, people have more money to invest. You tend to see stock markets rise. Of course, not without periodic corrections, sometimes quite severe, but nevertheless, you would expect, if I'm right, that this upswing has 7 years to go, you would expect stocks to be at higher levels in 7 years' time. The reason that we're a bit more cautious on the US is the valuations in the US large cap stocks, especially growth stocks. But I think valuations are okay elsewhere. Okay, that's about it from me. This is our 3 mugshots. You can't see Jerry and James, but that's what they look like. We produce publications, weekly, monthly, and quarterly, which are available to clients. And we also have our CIO service, where we aim to provide a much more personalized service to clients, where you can talk to us anytime and we'll present to you or your investment committee, etc., etc. And we also have various other things we provide: bespoke asset allocation if you need it. We'll help you with investment selection and analysis, investment advice. And James is our head of investment solutions and has lots of ideas on different solutions for your investment problems.
Okay, that's great. Thank you, John. And I think that wraps up this webinar, if that's okay with you guys. And John, thank you very much. And thank you very much for everybody for attending. Please get in touch with James, and we'll confirm that everybody will get a copy or a link to where the video of this webinar is, so you can download it or see it again if you want and look at the charts. And if you have any questions, please don't hesitate to get back to us when you can. Thank you, John. Thank you, everybody.
Okay, thanks, everybody.